Investing is about making informed choices, but how you decide what's informed depends on how you look at the market. Some investors rely on numbers and financial statements, others on charts, momentum, and price patterns. Both perspectives matter. Let's start with the fundamental approach. Fundamental analysis is about studying a company's financial strength, its competitive position, and its ability to generate profits over time. It's like reading a company's DNA, understanding what makes it valuable or vulnerable. A fundamental analyst reads financial statements, the balance sheet, the income statement, and the cash flow statement. From these documents, several key ratios emerge. The balance sheet shows what the company owns, what it owes, and what's left for shareholders. The equation is simple: assets equal liabilities plus shareholders' equity. The income statement covers performance over a period of time. Revenues minus expenses equals net income. The statement of cash flows explains how cash moves in and out, dividing it into operating, investing, and financing activities. From these come the ratios that measure efficiency and risk. The current ratio equals current assets divided by current liabilities. It shows short-term liquidity, the company's ability to pay bills coming due. A ratio above 2 is generally considered healthy. The quick ratio, or acid test ratio, removes inventory from current assets before dividing by current liabilities, offering a stricter measure of liquidity. The debt-to-equity ratio equals total debt divided by shareholders' equity. A higher ratio means greater leverage and greater financial risk. The earnings per share, or EPS, is net income minus preferred dividends divided by the number of common shares outstanding. EPS tells investors how much profit each share represents. The price-to-earnings ratio, or PE ratio, equals market price per share divided by earnings per share. It shows how much investors are willing to pay for a dollar of earnings. High PE stocks are often viewed as growth companies. Low PE stocks may be considered undervalued. Another measure is the dividend payout ratio, which equals annual dividends per share divided by earnings per share. A company that pays out most of its earnings as dividends may have limited growth prospects, but steady income appeal. A fundamental analyst also looks at broad economic factors: interest rates, inflation, and fiscal policy. Rising interest rates tend to pressure earnings and lower stock prices, while lower rates can encourage expansion. Now, let's turn to technical analysis, a completely different lens. Where fundamental analysis studies what a company is, technical analysis studies what investors think it is. It focuses on supply, demand, and market psychology. The basic data for a technical analyst are price and volume. They chart these to identify trends, upward, downward, or sideways, and to forecast potential reversals. A trend line connects successive price points to show the direction of the market. An uptrend is defined by higher highs and higher lows, a downtrend by lower highs and lower lows. Within those trends, analysts watch for support and resistance levels. Support is the price level where demand tends to stop a decline. Buyers step in. Resistance is the level where selling pressure halts an advance. If a stock price breaks above resistance, that's called a breakout and is considered a bullish signal. If it breaks below support, it's a bearish signal. One of the most recognized patterns is the head and shoulders formation. A head and shoulders top marks the reversal of an upward trend. The left shoulder, the head, the right shoulder, and a decline below the neckline confirm a bearish shift. A head and shoulders bottom, or inverted pattern, signals a reversal from downtrend to uptrend, a bullish indicator. Volume confirms these patterns. Rising volume during a breakout strengthens the signal. Falling volume may weaken it. There are also market theories that technical analysts use to interpret sentiment. The Dow theory looks for confirmation between the Dow Jones Industrial Average and the Dow Jones Transportation Average. If both reach new highs or new lows together, the market trend is considered confirmed. The odd lot theory assumes that small investors, those trading fewer than 100 shares, tend to be wrong at turning points. When odd lot buying increases, technicians often see it as a sell signal. When odd lot selling rises, it may be a buy signal. The short interest theory tracks the number of shares sold short, but not yet covered. A high short interest suggests many investors are betting against the stock, which can be bullish if the shorts eventually rush to cover their positions, driving prices higher. The put-call ratio measures the volume of put options traded relative to calls. A high ratio means investors are bearish, which can paradoxically be bullish if sentiment has swung too far. And the advanced decline line tracks how many stocks rise versus how many fall each day. If major indexes are climbing but fewer stocks are participating, it can warn that the rally is weakening. Fundamental and technical approaches often seem to oppose each other, but smart investors understand both. A fundamentally strong company may still have a poor chart, and a technically strong pattern may not hold up if the company's balance sheet is weak. Fundamentals tell you what to buy or sell. Technicals help you decide when. On the Series 7, expect to be tested on definitions, formulas, and how each school of analysis interprets market data. For example, a head and shoulders top is bearish. A breakout above resistance is bullish. High short interest can be bullish. The Dow theory requires confirmation from both the industrial and transportation averages. In practice, portfolio managers often combine both methods, using fundamentals to choose securities and technicals to fine-tune timing. Both approaches share one truth: markets are driven by people, and people leave patterns. The analyst's job is to read them clearly enough to act with confidence when the next opportunity appears. Next time, we'll explore portfolio and market analysis, how all these ideas fit together when building diversified portfolios, balancing risk and return, and applying modern portfolio theory to real-world investing.